This is Kenny Tan. Welcome to Real Estate License in 14 Weeks. This is episode 35 or starting from zero. We start talking about chapter 10. If you like my video, please give me a thumbs up, subscribe to my channel, hit the bell for further notifications, and share this video with your friends. Chapter 10, taxation. So we're going to be talking about mainly just federal income tax, and property taxes. First, assessed value. Assessed value is what we call value set by the county assessor. It is different from the appraised value. So sometimes the county assessor will set a value that is either higher or lower than the appraised value. For example, usually after the property closes escrow, the buyer will have to pay taxes, property taxes, to the county. And usually the county assessor will just accept the purchase price as the assessed value unless they feel that it is too low. And also a buyer or a homeowner may be able to appeal to have an appraised value reduced to the market price if he feels that it is overvalued. When does a homeowner need to pay property taxes? The tax year starts from July 1st and ends on June 30th. There are two installments to pay the property taxes. The first installment is due on November 1st, but it becomes delinquent on December 10th. The second installment is due on February 1st, but becomes delinquent on April 10th. If a homeowner doesn't pay his or her property taxes for 5 years in a row, after the 5th year, the county assessor can record the property as a tax defaulted property. What that means is that they can have your property sold at a tax sale to recover the property taxes. The key is 5 years. 5 years, if you don't pay your property taxes, you will suffer the consequences of losing your property through a tax sale. Let's talk about special assessment. Special assessment are just additional property taxes an owner has to pay because of some reasons. And one of the reasons has to do with the Street Improvement Act of 1911. If you have a commercial property that is next to a public street, now if the city or the local government wants to make improvement to the public street, such as to expand it, to repave it, and needs money, the government can actually ask the owner to pay special assessment under the Street Improvement Act of 1911. It has to be a property owner whose lot is fronting the public street, and how much you pay will actually depend on your frontage. Now let's talk about the capital gain tax, and this is federal law that we're talking about. For every sale of owner-occupied personal residence, if the owner occupied the property as a primary residence for at least 2 years within the last 5 years. Now the 2 years doesn't have to be continuous. You can aggregate the 2 years. If you can satisfy the requirement, husband and wife can exclude $500,000 from the capital gain. That means that the first $500,000 from the capital gain is tax-free. I'll give you an example. Let's say husband and wife purchased the property several years ago for $500,000 and then sold it for $1 million. And then they satisfied the requirement that they lived on the property as a primary residence 2 years out of 5 years. That means 365 times 2. That means 730 days within the last 5 years. In that case, the capital gain of $500,000 can be excluded in its entirety because they qualify for the $500,000 exclusion. However, if the taxpayer is an individual, by way of an example, if the taxpayer paid for the house $500,000 when he bought it and then sold it for $1 million. Now, because this person is not married, he's single, his exclusion is $250,000. That means that of the $500,000 in capital gain, $250,000 is excluded. The remaining $250,000 is taxable. Well, how did I come up with a $500,000 capital gain? You just take the sale price minus the original purchase price, that is the capital gain. Next, depreciation. Depreciation is a tax benefit. If you are an owner of a property that is being held for trade, business, or investment purposes, In other words, it's not your primary residence. You can actually claim depreciation as a tax benefit every year when you file your personal tax return. The way the depreciation is determined is as follows. Now, let's say, for example, you get a tax bill from the local tax collector, the county assessor, that appraises the value of your property at $1 million. Of that $1 million, a certain portion is allocated for the land and a certain portion is allocated for the structure. Let's say $600,000 is allocated for the land and $400,000 for the structure. Now, because land cannot be depreciated, and that's an exam question, remember, land cannot be depreciated. So you can't really depreciate the $600,000, the land portion of the value of the property. You can depreciate the structure, which is $400,000. The easiest way to figure out how much total depreciation you can get from the property that you own is by looking at the property tax bill. So the next question is, of the $400,000 that you can use depreciation on, over what period of time can you deduct the depreciation as a tax allowance? It depends on what type of property you have. For residential property, the depreciation is allowed over a period of 27.5 years. For commercial property, depreciation is allowed over 37 years. So in the example that I just gave you, you will take $400,000 and divide it by 27.5. That will be the annual depreciation allowance for a given year. So you can take that number, input it in the tax form, and claim it as a tax deduction. So that will lower your property taxes. Because depreciation is a tax benefit, it's always good to claim it. So some people might wonder, well, if I claim depreciation now, will the government get back to me because there's a loss in tax revenue? Yes, when you sell your property, there is such a thing called depreciation recapture. So they're going to ask you to pay back some taxes, not in its entirety, but there is a formula that they can use, that they use to claim back the allowance that you made. Next, what is a sale and lease back? If you're an owner of a property, you want to generate working capital. In other words, you own the property, but there is equity on the property. You want to take cash out of the property, but you don't want to leave this location. This is an excellent location, for example. How do you go about doing that without having to leave the premises after you have sold the property? So one way would be to sell it and then lease it back from the buyer. So the advantage to a seller on a sale and lease back is that the seller can generate working capital. And there's also tax benefit. The rent that is paid by the seller to the buyer as a tenant to the buyer is fully tax deductible. The seller, the lessee, had all of those benefits that I just described. But what about the buyer, the lessor? Lessor, as you know, is the landlord. By buying the property and having the seller become the tenant to the property, the advantage to the seller is that they have a ready tenant, so they don't have to go out and get another tenant. The benefit of having a pre-existing tenant or prearranged tenant is that it will help the buyer in getting loan or financing for the property. And also from the buyer, landlord's perspective, it also generates rent as income. And the buyer can also establish new depreciation basis. In other words, they can establish a new basis to calculate the depreciation for the property. I'll give you an example about the depreciation. See, when the seller bought the property, he establishes his basis for the depreciation. So over the years, he may use up the depreciation. Let's say, for example, he held it for 20 years and then sold it. So he had used up 20 years, but when a buyer buys the property, he establishes a new basis and can deduct the depreciation as a tax benefit. Next, we're going to talk about the basis for taxation purposes. Earlier, I showed you that to calculate the capital gain, you have to subtract the basis from the purchase price. So when the buyer bought the property, he established his basis. The purchase price is the basis. So in the case of a purchase, the basis is usually the purchase price. So when he sold the property, the difference between the selling price and the basis is the capital gain. You need to establish a basis in order to establish capital gain. The second situation that might involve basis is what we call give. Let's say a father bought the property years ago for $250,000 and then later on transferred this property to the son as a gift. Now in the case of a gift, you have a donor, who the person giving the property, and then you have the donee, who is the person receiving the property. Because the father bought it for $250,000 and the law says that the donee's basis is the same as the donor's basis, so the son's basis is also $250,000. Even though at the time of the transfer from the father to the son, the property might be worth, let's say, 1.25. So if the son sells it on the next day, the son will realize a capital gain of $1 million. That is the difference between the selling price, 1.25, and the basis of $250,000. The next situation that also involves the determination of basis is what we call inheritance. Inheritance will involve trust or probate. For example, when somebody dies, the person that inherits the property would have to have his basis determined. Now, the person receiving property using inheritance or as a person inheriting from somebody that just died, whether it's a trust situation or probate situation, his basis is not the basis of the person that just died. His basis is actually the fair market value of the property at the time the inheritance occurred. Let's say, for example, the person that died bought it for $250,000. At the time of his death, the property was worth 1.25. And through a trust or probate, someone else, maybe his heir or somebody that he wanted to have, the deceased want to have the property, will have a basis that equals to the fair market value, which is 1.25. But if he sells it the next day, his capital gain is zero because the selling price will be equal to the basis. Now, so in the case where the basis jump to the fair market value of the property, we call that step-up basis. How title is held to a property may affect the way basis is determined. For example, if title is held as joint tenancy by two persons, let's say person A and person B, on a joint tenancy, as you can recall, in previous chapter, I mentioned to you that joint tenancy allows for survivorship. So let's say A passes away, then B will inherit A's interest on the property. Now, when that happens, what is B's basis is the question. Well, let's say, for example, A and B, they bought the property for $1 million several years ago. And that means that initially, because it was a purchase, their basis is usually the purchase price. However, because it's a joint tenancy, the basis is split into half. In other words, the $1 million purchase price is split into 50-50, which means that A's original basis is $500,000, B's original base is also $500,000. And let's say years later, A passes away, A dies. So B will obtain A's interest as a survivor in a joint tenancy. Now, in that case, what is B's basis? Now, let's say, for example, at the time of A's death, the fair market value of the property is $2 million. That means that the basis was $500,000, but because it's a joint tenancy, the law allows the deceased basis to step up, which means that A's basis will be stepped up to $1 million, and B's basis will be at $500,000. So the total basis of B's interest, the total basis for B in terms of capital gain calculation will be $1 million plus $500,000. That's $1.5 million. If B sells the property the next day, what is B's capital gain? Well, B's capital gain will be $2 million minus $1,500,000, that means that B's capital gain will be $500,000. So that's important thing is in joint tenancy, there is step up. However, if both A and B are husband and wife, instead of taking title to the property as a joint tenant, they took title to the property as community property, as husband and wife, as community property with right of survivorship. Now, in that case, when A dies, not only does A's basis step up to the current market value, B's basis also step up to the current market value. So B's new basis will be $2 million instead of $1,500,000. So if B sells the property the next day, his capital gain is zero. What is a like-for-like exchange? Like-for-like exchange refers to an exchange known as a 1031 exchange. 1031 exchange is what we call a tax shelter. It allows any capital gain for the sale of a property to be transferred so that the taxpayer doesn't have to pay any capital gain tax. It's simply deferred. It is not exempted to the next property. Now, in order to qualify for 1031 exchange so that the capital gain can be deferred, the property that was sold must be exchanged for similar properties. It has to be property that is held for trade, business, or investment. So for example, if a property that is sold is an apartment is usually held for trade, business, or investment, then the owner exchanges it into a gas station. A gas station is also used for trade, business, or investment. This is what we call like for like. In the case of like for like, it qualifies for 1031 exchange, so the tax is deferred. This is the end of episode 35 of Starting from Zero. See you next time.